Okay, I thought we'll get started on time so everybody can leave on time. We know sometimes people don't like driving in the dark. It's kind of dark out there already because of the rain, but the sooner we can enjoy the program, the better. So my name is Jan Alford, and I'm a member of the Administration and Finance Ministry, and we're hosting this tonight. And Carolyn Marshall is our chair, and other people in the committee. A bunch of them are here, so raise your hands if you're here. J.R. Wilson, Randy Aubrey, Tom Bloom, Tom Cantonese, Vicki Melton, and David Stevenson, and also Bob Lowry. He had a conflict tonight, he couldn't be here, but we appreciate you all coming out, and we're really looking forward to the questions and answers at the end because it gives us a chance to get feedback, and that's always really helpful. So I thought before we have I introduce the guests, I thought we'd have a brief prayer, if you bow your heads. Lord, thank you for bringing us together tonight to learn about financial and estate planning, which may provide us additional ways to honor you. We also thank you for this opportunity to join others in fellowship this evening and for safely bringing us here to enjoy the presentations. In your name we pray, amen.
Amen.
So tonight, we have Becky Hale. I think most of you probably know Becky. Becky has practiced law for 37 years in the Low Country. She has her own firm with offices at Moss Creek, and that's where I live, which is convenient, and a satellite office near Sun City. She practices and works in the areas of estate planning, probate, real estate, and business law. And we're really fortunate to have her because she's very busy with real estate transactions now. All of you know how hot the real estate market is. She raised 5 children here in Bluffton with her late husband while working and volunteering her time in the schools here at LPC, and has served on the boards over the years of several nonprofits here in the Low Country. She has served on an elder session twice and served as a Stephen minister for 15 years. She is currently a member of the Bluffton Rotary and PEO Chapter AQ. She attended USC in Columbia, where she met her late husband and became a lifelong Gamecock. And at that point, we won't go any more into the sports. It's too controversial this time of year. Our other speaker tonight is Danielle Jeffcoat, and she and her team, and a member of her team is with her tonight, they work closely with CPAs, attorneys, and other professionals to address each facet of your financial strategy, including tax mitigation, estate considerations, and wealth protection strategies. She joined Edward Jones in 2010, opening the firm's 3rd branch office in Bluffton. She received her bachelor's degree in business administration from the University of South Carolina in 2008. She holds a Series 7 license, a Series 66 license, the life and health insurance licenses, as well as AAMS professional designation. Outside the office, she takes advantage of all Low Country has to offer with her husband, Trey, and her 2 young children. She believes strongly in community involvement and how important support of those organizations are to improve the quality of life for the charming Low Country. So with that, I'm going to introduce Becky.
Hi, thanks for having me here tonight. I appreciate the opportunity to speak with you and talk to you about estate planning. That's what I spent most of my day talking about, so nothing new to me. So not an exciting topic. I tell my clients when they drag themselves into my office, it's about as exciting as going to the dentist. That's about how excited they are when they see me. They really don't want to do it, but they realize it's just a necessary part of life. I found this quote this week, and I never realized who said it before until I found it. In this world, nothing can be said to be certain except death and taxes. I never realized that was Benjamin Franklin who said that in 1789. How right he was then and now. So that's why we plan. We plan where our assets are going to go when we die. We plan who's going to be in charge if we become incapacitated during our lifetime and need assistance. We plan what healthcare measures we want and don't want if we become ill. And we plan our final arrangements so our family knows what we want and makes it a little bit easier for them at that difficult time. So I thought I would just kind of start with y'all and go through how I do an estate planning session to give you an idea of the kind of things I talk to folks about when I've been trying to come up with an estate plan and a way to set things up for them that makes their life easy, their children's life easy, and less complicated way. So we don't have to talk that much about tax planning with what I do because, you know, the state limit right now for federal estate taxes is $12.6 million a person this year. So that means each couple can have $25 million in not paying estate tax. So my clients, if I do ever have a client come in with that much money, I usually send them to a tax attorney friend of mine who can help them with that because that's just beyond anything I might try to plan for if someone has that kind of a portfolio. So I usually start out with that and make sure. Now that is going to change. In 25, that's going to be cut in half, but you're still talking about $12 million. So that's still a pretty good chunk of money. So what I start with when I'm talking with folks and starting an estate planning session is ask them about their real estate. I go online, I print out their deed, look and see if they have a mortgage, make sure that they own their house if it's a couple, joint tenants with rights of survivorship, or if they have a trust, if it's in their trust. Because we try to plan so that when there's a couple, the first to die, there's no probate, there's no estate, life just goes on for the surviving spouse. And so if you plan things correctly, that's what will happen. And believe it or not, most people have most of that already in place, they just don't realize it until I talk to them about it. So I ask about the real estate. If they have real estate in another state, that might be a reason why we might consider doing a trust. But timeshares are a big issue because what are you going to do with those? You don't want your kids to have to pay for those forever if they don't want them. So we look at how the real estate's titled. And then I talk about bank accounts. If those are joint, not all my clients are married, some are single, but even your bank accounts at Wells Fargo, Bank of America, you can put a beneficiary on that. And if you have 2 children, you're leaving everything to your kids, no need to have that account go through probate. If there's just one of you on the account, you don't have a spouse left, you can put beneficiaries on all those accounts at your banks. That's all kind of new. When I first started this, or maybe 20 years ago, the only things that had beneficiaries were really IRAs and life insurance. And then it's progressed, so brokerage accounts and bank accounts can all have beneficiary designations. So things that used to be, that would have to go through probate, doesn't have to go through probate. Most things can transfer on death, except for your real estate and your cars. So cars are something that we have to deal with a lot of times when there's a couple and one spouse dies. If the car is not in both names and a spouse dies with a car in their name that's worth less than $25,000, we can transfer it. The judge will sign. We send over an affidavit and the judge will sign it and allows you to go to the DMV and transfer the car. But if it's more than $25,000, you have to do a full-blown probate. So it's real important on your vehicle titles, if you don't have a lien on it, that you own the cars jointly and put or. So just a easy thing to take care of. So again, if you're a couple, now if you're a single person, makes it a little bit more difficult. But if you're a single person owning a house, there's going to be a probate anyway. So the car isn't really that big of a deal with that. Then we talk about investment accounts and how they're titled. If they're joint, if they have a beneficiary. IRAs by their nature have a beneficiary. So usually those are taken care of, not an issue. But, and most brokers are really good, like Danielle. She would talk to her clients about that and make sure that there were beneficiaries if the account was not in a trust. So that's something you should talk to your broker about. Make sure those accounts are either joint with your spouse or have beneficiaries. And I even like the idea, going ahead, if you have children who are going to be the ultimate beneficiaries, even if it's a joint account, see if you can list them as beneficiaries. Not likely you'll both die at the same time, but in the event it happened, that would be taken care of. So LLCs, that's another thing these days that we can put in an operating agreement that if you, a lot of times people want to do single member LLCs so that they don't have to do a separate tax return. A lot of people have LLCs around here that they own an investment property or rental property in. And if it's just one spouse on it, then there's no separate tax return. It's a single member entity. It's just like a K-9 on your tax returns. 2 members, you have to do a separate tax return. So they'll set up an operating agreement and say, when I die, my spouse gets this. And that works out pretty well. I usually check with the CPAs because they're the ones who are going to be filing the return and changing who owns that. So I always check with the client CPA when we do that. But generally that's worked out pretty well, transferring to LLCs like that. But another place people get stuck in their planning, and we end up having to do a probate when one spouse dies, government bonds. So many folks still have some government bonds in a drawer. If they're worth less than $25,000, we can get the judge to sign an affidavit and transfer them. But if it's more than $25,000, again, you might have to do a probate. So if you have government bonds, see how those are titled. If they're not joint, see if they can be cashed in, or go to the Treasury Navigator, you know about that? You can go and set up a paperless account and put beneficiaries on it. It's great. And I don't think you have to get a CPA to do it or attorney or anything. I have clients who do that all the time. So that's just an easy way to handle those bonds and take care of it. So the answers to all these questions, what you own, how they're titled, has a big influence on how we're going to set up your estate plan. Whether it's a second marriage and maybe some assets need to go to children on one side of the family, some assets to another, all those things we take into account and decide if a simple will work, or we can do a long form will. We need to have some trust provision for a child, maybe even an adult child who can't handle money and should not be given a large sum of money just outright. We can do a testamentary trust and still not have to put the home in the trust and other accounts in the trust and handle it that way. Make the this testamentary trust could be the beneficiary of a life insurance policy or of a IRA, which wouldn't be the best way to do it, but brokerage accounts, different things like that. So then the next step is we might have to do what's called a revocable living trust. If there are other issues like, say someone owns a home, they're widowed, separated, divorced, whatever, and then they remarry and the new spouse is going to move into the home. And I mean, it's a very common situation, and the spouse who's moved in wants to have a place to live and the other spouse wants to provide it, but they still want that home to go to their children at some point. So you do a trust and allow for that new spouse to live in the home for their life. And so there are a lot of reasons why we do trusts. Most people don't need a trust. In my opinion, it's better if you have a simple family, not a lot of drama, your kids are trustworthy and responsible adults, and you're not trying to keep the money and hold it back from them. The money can just be paid out by your broker, or by a life insurance policy straight out to the kids, and you don't have to have that flow through a trust. Have one of your kids have to be responsible for it, congregating it, then paying it out, and accounting for it. Let your broker do it. Keep life simple, and a lot of folks can do that. There are some reasons why some people can't, and we figure out a way around that. But for the most part, most of my clients, their kids are reasonable, and they let their accounts, when the second one is gone, be paid out to their children as beneficiaries. So the question I get from people is, oh, probate in Beaufort County is awful. Nobody should do a probate. That's what I went to a seminar and that's what I was told. No, I do countless probates, open up several probate files a week, and for the most part, it's really not the nightmare that you've been told it is. Some people have problems, but for the most part, everything flows through and is pretty simple. Not many filings, it's not expensive, you're not paying taxes. For example, if you have a probate estate, and like I said, your probate estate should just be, for the most part, if you're keeping it simple, your house and your car. So if your house and your car values $500,000 after the mortgage is paid off, that's the net value. Your tax or your admin fee to probate court is $700. That's not a lot of money for a filing fee. Attorney's fee, you don't have to have an attorney to file a probate. If your kids are reasonably smart, they can get, the forms are online, they can fill them out, get them notarized and send them in themselves. We do have clients and people we meet who do probates for their parents. They do find jobs, they come to us and when they need to sell a house because they can't do a real estate closing. So at least a couple of times a year, we'll do a closing for children who have done the whole thing and just need assistance in selling the house. Usually probate filings, I have a licensed paralegal who helps me with that, and the fee for that runs about $1,000. It's not a lot. It's not, shouldn't be more than that. I mean, sometimes there are issues and extenuating circumstances, but if you're just doing the paperwork and your executor is gathering your assets, your house, cleaning it out, your stuff, and getting rid of the stuff, selling the house, it really ought not be a big deal. When you die, they have to file the will, they have to file it with the death certificate and the application saying, I agree to be the executor. And then 90 days after that, they have to file an inventory, and that would probably just be the house and car. We don't have to list assets. Some people have some valuable paintings and really valuable jewelry, and we list that, but for the most part, it's usually, in the scheme of things, not something we have to list. So they list the house, they list the car, and by that point, they probably sold the house. And we just put down what they sold the house for. That's after 90 days. Then the estate has to stay open 8 months. That doesn't mean they're doing anything. If they had a will that says they could sell the house, after the 90 days, the house is probably gone. They probably have the money in the bank for it. And say there are 3 kids and they have $500,000 sitting there. They don't have to let it sit there for 8 months. They need to hold back some money in case some kind of crazy claim comes in, but after 3 months, the credit card companies, they've already heard from them, their hospital bills, they've heard from them. There's probably not gonna be $500,000 in claims unless that person was in an automobile accident and killed someone at the time they died, and there's like maybe a lawsuit hanging out there or something. But they can usually, hold back what they feel comfortable with, $50,000, $100,000, keep that for the 8 months. And then after the 8-month period, they have to file an accounting showing money in, money out, and receipts from the people who received money. I received my share of the estate, they just signed that, and request to the judge to close the account. So yeah, the estate stays open, that all probably in the scheme of things takes about a year, but it isn't like anybody's had to go to court, anybody's had to answer to the judge every month, it's like 3 times. So really not that complicated, and really not that expensive. So one thing a trust does for you is it avoids probate. But if you're gonna do a trust, you gotta go back and put your house in and go through reassessment with Beaufort County. If you have a mortgage, you have to ask the lender if you can do that, if they'll give you permission to do that. So there's a lot involved with that. And I've seen just as much drama with trusts as I have with wills. So if there's family drama, a trust isn't gonna keep the kids from fighting. It's just gonna make it worse because they don't, with a probate, there's a judge who's signing off and looking at all the paperwork and seeing if everything adds up and balances out. With a trust, there's nobody looking over that person's shoulder. It's all on them, and invariably one of the other kids will think that, or sometimes this happens, I think my brother's stealing the money. I think he's got more money and just hasn't told us. Well, who's gonna, there, unless that one brother sues the other one, no one's ever gonna know. Cause there's no account. That makes it. So the will, after we decide what we're gonna do, say we're just doing a simple will, we decide who the beneficiaries are gonna be, if they're gonna be charitable donations around here. Frequently, my clients leave money to the church, their churches. They leave money to St. Jude's, that's really popular. Oh my gosh, we have a visitor. And for many years here, Chuck, you probably remember our cardinal.
Yes,
We had a cardinal every Sunday who would be up there knocking on the door.
yeah.
It was amazing.
That's Frank's bird and it's still here.
Oh my gosh. Pet charities, that's real popular around here. So those are the kind of things that we see. Another thing your will can provide for is a memo. We have this nice provision in South Carolina where one of your grandkids is visiting, say, I really would like to have grandpa's pocket watch. Oh yeah, I'll leave it to you in my will. You don't have to go back and redo your will. You just put it on a list and sign it. And we put a provision in the will, that's perfectly fine. I have some people who do spreadsheets. Some people who do the list and they take pictures of everything, so they make sure that people get what they want. But that's perfectly legit and a great way to give things out to grandkids, neighbors, friends, family. So just keep in mind, if you think you don't have a will, you've never done this, but you do have one, the state's written one for you. And if you have a spouse and no children and you die, your spouse, if you have a spouse and children, your spouse gets half, your children get half. And if you have no spouse, then the children take all. So, and then on down the line, like then you're no spouse, no children, then they look to see if you have parents or if you have siblings. So, there's a whole list of how that works. But if you, and intestate, we have people who die intestate all the time. Not really a big deal, except they can't sell the house. There's no allowance to sell the real estate. So if they have an expensive house with a lot of HOA fees and insurance and whatever, they have to pay that for the 8 months and then have it distributed to the heirs, and then they can sell it, or we can try to get a court order allowing it to be sold. And then usually the court will say, okay, fine, but it has to sit in the attorney's escrow account. So it's just easier to have a will. It's not that expensive. There are a lot of attorneys around here who charge a pretty reasonable fee. I don't recommend, I'm doing this week, in fact, someone who died who had done an internet will, and I've seen those, and most times they're good. This lady's was not. She was selling her house and died unexpectedly, and now we have having to get a court order, which is quite expensive, to allow the kids to sell the house, because there was no power of sale in the will. The will was not sufficient. She had a will, but it wasn't sufficient. So it's just better to get someone to help you with that. So the other thing you need is a power of attorney that allows someone to take care of you while you're still alive. We make them very broad ranging because we don't know what might happen. Usually if you have a spouse, you're going to name your spouse first and then your kids or whoever you want to name. But it's never going to be your spouse, because you can take care of your spouse. You can pay the bills. You can put your spouse in a nursing home. So generally, it's the person you name second on there who is going to be in charge if you have issues and need it. The good news is, I find in my practice, most people, we do the power of attorneys, but they never need them. We just die. But if you don't have it, and then your kids have to go get appointed to be your guardian and conservator, that's difficult, that's cumbersome. The probate judge has to approve all the checks that are signed. They'll be mad at you. So it's just easier to get the power of attorney, have it just in case you need it. And there are two ways that can be done. Some folks don't want to give their kids immediate power, so they'll make it springing. So 2 doctors have to say they're incapacitated before it's actually valid. So it just depends on what your comfort level is with your kids. And it's very broad, the one that I do, it allows pretty much your agent to do anything but rewrite your will. They can sell your house, they can get in your investment accounts, whatever they need to do to pay your bills, take care of you, make sure you're not out on the street or left in the hallway at the Life Care Center on Hilton Head because there's nobody in charge. I heard that story once till somebody, some poor man had no family, no power of attorney, and he wasn't a client of mine, so I can talk about it. And he was out there for 4 weeks till finally, they couldn't put him in a room. And I guess somebody got a court order and they got him moved, but he had nobody, no documents. So very, very sad. One of the worst things I've heard of that could happen that way. And so then the next thing we address are your healthcare directives. So we have a living will in South Carolina that asks if you want food and water, if you're terminally ill, or food and water if you're brain dead. Terminally ill, you're dying. You haven't just gotten diagnosed, you're actively dying, so they just take the fluid line out. And then the other one that goes along with that is if you can't talk to the medical providers, who's going to speak for you? So most people put their spouse and then their children or some other trusted person who will talk if you're not able to. And then that asks if you're going to let your agent have discretion to make decisions, or if you're just having a straight DNR, no medical treatment. And then it asks if you want tube feeding, you're going to let your agent decide, or no, under no circumstances, no. So I'll tell you an interesting story in my office. I think Linda was probably there that day. I have like 8, 9 ladies in my office, and the pandemic started, and it's 2020, and we'd all put on there no medical treatment, no tube feeding, because we didn't want to put that burden on our kids, And I started thinking, oh my gosh, we've all got that on our healthcare power of attorneys. What if we got COVID? And what if we needed a ventilator? We're just going to die. Well, at that point, if you went on a ventilator, you're probably going to die anyway, but at least maybe you had a chance. So we all sat down at lunch one day and changed it and gave our agents, in some instances, who are our kids, the discretion to make that decision, which I never thought I'd let my kids make a decision about putting a feeding tube in me, because I never wanted that, but things changed and I kind of looked at it differently. I don't know if I'm going to go back and change it now, but for now, we all sat down and thought, oh, maybe that's not a good idea to have a DNR right now. And most importantly about that is talk to your kids about that, because even if you don't want tube feeding and you don't want your life prolonged, I can tell you that if you have a child who's telling the hospital they're going to sue them, they will put in a feeding tube and they will not take it out, even if that's not what you want. So tell your kids you will haunt them if they do that to you. Because it is not a good thing. So one thing you should do is talk to your kids about that, get your documents in order, leave them information about your accounts. If you've got a spouse, you're in pretty good shape. They know where everything is. But if it's just you, make sure you got that somewhere where they can easily find it. Passcodes. When my husband passed away 10 years ago, we thought we'd done everything and had everything right. I didn't get his passcodes. And unbeknownst to me and his secretary, he had a password on his emails that we couldn't get on his emails, and which was kind of a good thing, because someone would call and say they sent an email, and I'd say, I'm sorry, I haven't seen it because I can't get on there. And eventually it filled up and they got a message. That was 10 years ago, back when that still happened. And eventually, after a couple of weeks, it filled up and they got the message. This email is full. You can't leave a message. So that was great. But yeah, get passcodes. It just never dawned on me. So that's important too. And make a funeral checklist. Decide if you're going to be buried. Decide if you're going to be cremated. Your kids need to know, because guess what? In South Carolina, if you're going to be cremated, it is not your decision. It is your next of kin's decision. So if you have a spouse, it's your spouse who signs at the funeral home. And if you have 3 children, all 3 children are expected to sign the form. So if that's what you're going to do, you need to let them know that's what you're going to do. And if you're estranged from one of your kids and you don't even know where they're at, you better make some prior arrangements with the funeral home, because that can get pretty sticky. So keep that in mind. So that's my synopsis on estate planning. And I'll let Danielle talk, and I'll be happy to answer any questions y'all have at the end.
Thank you, Becky. Great job. Hey everyone, it's always a nice light topic, right?
That's why we wanted you to laugh.
Yeah, I gotta brighten up the room a little bit here. So I appreciate all you guys coming out tonight, and so many things that she said are so important. And before I go in, I wrote 2 things that I wanted to bring up to reiterate the importance of it. The power of attorney. You know, at Edward Jones, if you have accounts with me and you are no longer, you're showing signs that you're not able to make decisions, or you're not making decisions that appear, you know, normal to your history, or potentially of an Alzheimer's or dementia diagnosis, if we don't have a power of attorney, it really puts us in a really big bind to be able to get you money and to be able to distribute assets on your behalf. So please, just not just for healthcare purposes, just have a power of attorney. And beneficiary designations, 100% of what she said. It's very easy at a financial firm to add children on as beneficiaries. We always recommend contingent beneficiaries. If your estate's pretty clean, you got a couple kids, everything's going to be 50-50. Just get it all set up. Tell us who your power of attorney is. If you know anything, the more that we know, the more that we can help any one of you during a time of need or during a time of crisis. So what I'm going to transition this conversation to is charitable gifting, different ways to use your assets in a tax-efficient manner to benefit charities of your choice, like this church or other charities that you are passionate about. So the first one I'm going to talk about is a QCD. QCD. That is short for Qualified Charitable Distribution. I put a fact sheet on this in your folders. When you take home and you want to read more about it, you can. But sometimes it's nice to hear somebody explain this. So what a QCD is once you are 70 and a half, you are able to start taking distributions from your IRA and sending them directly to a charity of choice. So let me walk you through what that would look like. You had an IRA at Edward Jones, and you said, we were talking, and you said, I want to be able to send $5,000 to my church. That would have to be a transaction that is from Edward Jones, and it goes, you would send me the information, and it goes directly to the church. You do not receive the funds. Why that is really important, and why that's something a lot of people don't know about, is it can be a big tax savings for you. So there's a couple ages and items to keep in mind. 59 and a half is the first time you can even touch an IRA without being penalized on your distribution. So 59 and a half, you can go in and you can cash out your IRA and have a party. Well, the negative of doing that is on a traditional IRA, every dollar you take out of the account is taxable to you as ordinary income. So it's usually pretty rare that somebody cashes out a traditional IRA. Once you get to the age 70 and a half, that is when you can do a QCD. But 70, that's when you can you're still in that optional period to take money out of your account. And when you turn 72, you are now forced to take money out of your IRA, regardless if you want to or not. So I find a lot of times clients typically don't consider QCDs until they're 72. But there are, with the Secure Act, this was an act that was passed in 2020, that's what changed the age to 72 for your required minimum distribution, but that act did not change the age of the QCD, which is 70 and a half. So also in 2020, they changed our standard deduction. So prior to 2020, you would, let's just use the example, you go to church on Sunday and you tithe, and you write a check, or you donate online, or you put some cash in there, and you track that. And you would go and file your taxes at the end of the year, and you would itemize your deductions, and you would claim all of this money that you donated to St. Jude or to the church and it would be a tax deduction to you, right? Do we all agree with that? So what happened in 2020 with the Secure Act is they increased the standard deduction. So a lot of people that used to itemize no longer itemize because of the increased deduction. I'm not saying that that has stopped you from donating to charities, but it is nice to get a tax deduction for the things that you do, because the government, I think we all agree, they get their fair share of taxes, right? So a way around this is, instead of taking your required minimum distribution, you take that money and you send it to your institution of choice, and that is now your tithing or your donation, or it's in addition to. So let's just use some math here. Now, you have a $100,000 IRA, and your required minimum distribution is about $5,000. Okay? So you take that $5,000, and we've had a conversation at the beginning of the year, and you say, Danielle, I have plenty of cash flow. This year I would like to give all of my distribution. You know, I normally donate on my own anywhere between $4,000 to $5,000 anyway, on a regular basis, and instead of doing it, I would like to be able, and I can't get a tax deduction for that, so I would like to take that $5,000 from my IRA at Edward Jones and send this to my church. So we would open a separate IRA for you, and that's where your $5,000 would go. And you could get checks if you wanted to. If you like, sometimes some clients that really like that concept of writing checks and, you know, and going with their normal weekly tithing. And so you could write checks, and your responsibility with communication with me is that we're going to write it so that $5,000 at the end of the year is zero. And all of that money went to the church. Even if you feel that you're not in a financial place that you could do all of your QCD, maybe you only want to do half of it, well, you can still do half. You're only going to pay taxes on the difference instead of the whole thing. It's a really nice feature. Check writing is optional. You can be like, I don't want to do checks, and you'll send it off for us. And we have clients that we set it up. We send it off for them monthly as a direct deposit, or we mail a check. So there's so many ways. It's just the concept that you can take your required minimum distribution to charity or charities of choice. There's not a limit to how many you do. Why that is nice is because your required minimum distribution is taxed to you as ordinary income. So if you are in one of those, if you are somebody in this room that used to be able to itemize, does not itemize anymore because you don't have enough normal deductions, you take a standard deduction, you are charitably inclined, you are in QCD mode over the age of 70 and a half, you can start taking this money and not claiming anything from your IRA as ordinary income, like it normally would have been. Ordinary income affects taxation of Social Security, it affects taxation of Medicare, so there's a lot of negatives with the more income you have in retirement, and so any way that you can mitigate that, that's definitely a solution, and a solution that is not utilized enough in my opinion. Another way to donate to charity is, just through cash gifts. So that's something that you all may know. Another way is through appreciated securities. So if you, let's just use Apple, right? You have 100 shares of Apple sitting in a brokerage account at the bank. And inside of your Apple, you put $10,000 in there years ago, and now it's worth $50,000. Well, if you sell that stock while you are living, you are paying capital gains on the difference, right? So I said you put $10,000 in Apple, it's worth $50,000. You call me, Danielle, I'm ready to sell Apple. I go, okay, but you're going to have a $40,000 capital gain though. Then you're going to pay taxes on capital gains, which will then probably make your Social Security more taxable and probably make your Medicare more taxable. And it just becomes this trifecta of taxation and retirement. So you can take an appreciated security and donate it to your charity of choice. You receive a tax deduction for that, and you pay no capital gains because you're not selling it. So you get two benefits. Now, these are things you don't make the decision on your own, right? You work with your financial advisor, work with your CPA. If you don't have a CPA, then I can help you with it if you do it on TurboTax or something. But there are ways, a lot of really great ways to be able to benefit really lovely organizations and for you to still get a tax deduction on your distributions. So a lot of what those items factor into, and something else to keep in mind, the Secure Act did a lot of things. The other thing that it did is it made beneficiaries of IRAs liquidate that entire account in 10 years. So not spouses. So you have $1 million IRA, something happens to you, your spouse is the primary beneficiary, your spouse inherits that IRA and takes it over just as their own. Fine. Your children are then the next beneficiaries when something happens to the spouse. Your children, normally, based upon ages, are usually in pretty good earnings years or closer to retirement, maybe when their parents pass away. Maybe they're in higher income years. They receive this $1 million IRA. John and Jane get it, so they each get $500,000. They have to have that account valued at 0 by year 10. So what does that mean for the government? That means they are forcing this account to be liquidated over a 10-year period of time because now they can get, that's all income to them just as it would have been to you. They can get a lot more tax revenue during that 10-year stretch. Before 2020, non-spouse beneficiaries used to be able to stretch this over their lifetime. So you would just have to take a little R&D and keep the money invested and growing, and it just became lifetime. And the government said, we got it. This is not right. Everyone's just stretching all this tax-deferred vehicle. We want to be able to get some of our money. So that's another reason you would maybe consider taking money out of your IRA before R&D so you can start to reduce the overall amount that's in your IRA and increase the amount of money that you have outside of an IRA. It is more tax efficient to beneficiaries when you leave non-IRA money versus IRA money now. That used to not always be the circumstance. You can also add charities on as direct beneficiaries. So if something happens to you on your IRA, you don't have any children, you don't want to leave anything to your children, there's lots of different circumstances, you can leave it to a charity. You would just give me the tax identification number, the name of the institution. We would list that as one of the beneficiaries. If they can have multiple beneficiaries, and your money would go straight tax-free upon your passing to the people and or charities of choice. Okay? Another way to do a little more enhanced charitable donations is something that's newer to Edward Jones. It's called a donor-advised fund. A donor-advised fund is that you have a, maybe you tend to be pretty charitably inclined in general, and you have a desire to start leaving a legacy for your charity of choice, or charities of choice. You would take a lump sum up to $100,000. That would be a tax, and in the year that you fund your donor advised fund, that's a taxable deduction to you in the year that you put the money in there. You put it in there, you allocate it towards your charities, and then that money is then invested through your risk profile. It can be conservative, it can be aggressive. It grows tax-free, and all distributions throughout your lifetime and upon your passing are all tax-free for the charity. So it's this is not the first item I spoke about was tied to IRAs mostly. This is for non-retirement money. Oh, sometimes you might have a really big tax year, you sell a rental property, you sell a business, you do a Roth conversion. You know, there's something in your life, you sell that Apple stock and you get a huge gain. And you're trying to find ways to reduce your tax liability. And you are also charitably inclined, that is the year you can set up the donor advised fund and end up mitigating a lot of your tax gains. So those were the main points. I mean, you can donate real estate, you can donate art. I think those are more specialized conversations, one-off conversations, because those are usually pretty large assets. So that would be something I would recommend we have more on a one-on-one basis. But what I really wanted to cover today were these two items, the QCD, in addition to the donor advised funds. So I think that will be a good time for us to open it up to questions for myself or Becky.
Okay, I have a first question.
Oh, perfect.
You always have to break the ice.
Break the ice.
Okay, if you do the QCD,
Mhm.
is there a limit to how much you can do every year? Or is there a limit to how much you can give to any?
Yes, so with the QCD, there are some formulas, but the easiest way to just do the black and white version is up to your required minimum distribution.
Okay.
And for those of you that have not hit 72 yet, and you're trying to figure out what your required minimum distribution might look like in that year, it's usually about 4.5% of your account balance in the year that you turn 72. So, and then it increases every year. It's not exactly, there's a divisor, but if you just look at the basic calculation, it's about 4.5 to 4.8% of your December 31st account value. So you got $1 million in there on December 31st, you turn 72 in June, your 4.5 to 4.8% is based upon the value of your account on December 31st. And then every year going forward, it's assessed again based upon your December 31st balance. Good question.
Does South Carolina have a state tax?
No.
No. I just moved down from Illinois, so that's why I asked.
Yeah.
Well, that's part of why I thought this was good, because we've got new members and,
Mm-hmm.
you know.
Do you recommend most people that move from another state to do their trust, if they have a trust?
Have an attorney look at it. It's generally okay. Sometimes if it says Illinois, well, I change it to say South Carolina. So you could have to pay, I think the limit there is $4 million. The other thing I tell people about is if you're moving down here from Illinois or Pennsylvania or somewhere and you have bank accounts, not like in Edward Jones, but like in XYZ Bank, a local bank, and then you die and you leave that money to your kids, they may take out estate taxes at the state level. I've had that happen to kids, and they're like, what? So I always tell people that might be a reason to, if you're in a state like that, some states it starts at 250,000, just depends.
So Becky,
Look at
would
that.
the same thing be true if they had this, you know, bank account in another state and it's over a certain amount, you might have to have a probate? For that?
No, there just might be some estate taxes
Okay.
taken out, even if it's got beneficiaries on it. There's
Doesn't make a lot of sense,
no,
right?
No, but just something to check on.
A way to get money.
A way to get money, you're right. Yes.
Yeah, based on the recent January 1st, I believe, the divisor changed for the required minimum distribution. So people have to be a little careful. It's not a big change, but based on people living longer.
Right.
The second thing that I think we want to be sure everyone's aware of, once you meet your required minimum distribution for the year, you can move money from a traditional IRA to a Roth
Mhm.
once you meet the required minimum distribution.
Right.
And, I find that very useful.
Yeah, that's called the Roth conversion. So remember I mentioned doing a QCD to offset, maybe you plan to do a Roth conversion. I could spend hours talking to you about different investment types, but basically the main difference in a traditional IRA versus a Roth is every dollar you take out of a traditional IRA is taxable to you, because at some point when you put money in, you received a tax deduction, the money has grown tax-free, and now it's time for them to collect their dollars. A Roth, on the other hand, which was less popular when a lot of people were saving, or really not in existence for a period of time, saving for retirement, is a Roth is all of you don't get a tax deduction upon your contributions. It all grows tax-free, and on the back end, it is all tax-free. So mostly, a lot of individuals as they approach retirement, they save through their 401ks and things through their employer, and they just naturally chose pre-tax or Roth wasn't an option. So I find in the clients that I work with, it's not uncommon with your net worth to have more of your net worth in a retirement account versus in a non-IRA. And so you're trying to plan that sweet spot in that strategy going, how do I get more out of this taxable account into this non-taxable account without causing significant tax repercussions in retirement? Sometimes you go, I'm just gonna take the big hit one year, I'm gonna plan this out. But that is a lot more beneficial for true legacy money and money that you don't need to live on a monthly basis. So if you're in a good financial situation that you don't need the IRA and it doesn't affect your lifestyle, Roth conversions, and you have legacy desires, can be a really nice plan.
Yeah, when you have the Roth conversion, all that Roth money is not subject to the 10-year rule for the beneficiary. You had mentioned the 10 years they have to deplete the IRA
It's
money.
not taxable.
Yeah, right. So that's a big benefit of a Roth also.
We have to realize too that your Medicare and
It does go up.
prescription
yes,
costs
yes.
go up
Right.
quite a bit.
That's
For about
part
two,
two.
you're
Yeah.
basically, when you do one big, large taxable event in retirement,
Yeah.
with your Social Security and Medicare, you're at about a 2-year window of trying to get yourself caught up. You can spend the time, you can plead your case, say this was a one-time event, and you might get the right person on the right line, and I've had some clients have some success with it, but you are committing some time and energy into battling that. But that is something I think where mistakes are made so much. You do something in retirement, you have a big capital gain, you sell a property, you take a larger sum out of your IRA just to put in your bank account, and you don't realize the Medicare tax is as sneaky as well as the Social Security tax. Good questions. Anybody else have questions?
So on the donor advised funds, is that a one-time lump sum or can you do it?
You can do it over multiple years.
Okay.
And it's very flexible on the back end in terms of, and it just has to be a nonprofit organization. You could set it up where you are, that money was, if it's invested in a high growth, that can grow rapidly. And that can be a significant legacy for someone at your passing or also throughout your lifetime. It can also be stretched beyond your passing where donations continue to go in honor of your name. So it's a way to leave a legacy even further for something that you're really passionate about. And your children or your beneficiaries or someone trustworthy can manage that for you. Good questions. Anybody else?
I was just gonna comment, UCD actually is $100,000 max.
Right, yeah, but it can't be if,
It can be $100,000.
but if your IR, yes, but a lot of times you want to make it, it's not
There's tax
typically,
reasons why you would,
Right,
yeah, but you
right.
can get the money.
right,
So on the DAF, I'm just gonna say, so I work for the National Christian Foundation. Last year, we took in $3.5 billion. And so this is what I do nationally. I go around and do those stocks. Just think of it as a charitable checking account.
mm-hmm,
It's a great way for you at any point to put dollars in, you go tax-free, and then you can give it as you see fit. You can give it to your, the trust can go in there, all kinds of things you can do.
right. I've found that a lot of clients like to still, they like to have still a bucket of money available unless their IRA is of substantial value that, it doesn't affect. But I tend to see more of it trickling year over year to match. And like I say, the easy way to do it is if you tithe $10,000 a year normally, you can match that, and instead of taking it out of your bank account, you take it directly from your IRA. So it's very personal and up to whatever works best for your financial situation.
Okay, anybody have any other questions? I hope this was helpful. Can I have some shaking hands? Did everybody learn something new? It was raining, so we couldn't be eating outside at some nice restaurant. Our options were limited.
I was telling Jan that, this is my first events. Before COVID, I did a lot of speaking events for dinner events for clients or prospective clients or organizations, and the joke in our office is every time we scheduled one, it was a downpour. So here we come, it's been 2 years, and what is happening tonight? We looked up and we're like, what is going on? So, you're welcome, I brought the rain. It's normally what happens every time we do one of these events. If you're curious if it's gonna rain next, call my office. I'll tell you if you have an event scheduled, and if we do, probably a pretty good chance. So, I left my card, my information. If you ever have any questions personally, you can call my office. There's no cost for a conversation, ever. So I'll be more than happy to guide you and hopefully to help this wonderful organization here. So, thank you all so much for your time, I appreciate it.
Give money out. My husband and I we have no children, and we have enough money to live on, so I get the RMD every year, and I give it all away, and between the two of us, there's probably 15 different institutions who get the money, so you know, you don't have to apologize that you want to spread it. And it's, you know, it's feel-good money, and there's just so many charities. Good, I give to my universities this way. I mean, there's just so many ways to give. I still give extra to the church.
Come on. I was waiting for that.
No, I'm saying I give my IRA money, and then, you know, they pass the plate and give to Ukraine and so forth. So we give more money, but it is such an easy vehicle. That's why I like it. Okay, so thank you both. We appreciate it. And I'll close with a brief prayer. Thank you, Lord, for this evening event and the subsequent discussion. Thank you also for the generous contributions from LPC membership that has made it possible for us not just to survive, but to thrive during the pandemic. And in your name we pray, amen. And I want to thank Chuck, because I was saving this to the end, because he's filming this, and we're going to make it available on the website to people who didn't come. So if you have friends who didn't want to come, tell them it's going to be there. And Chuck and Bob do the live streaming, and they have done this every week since October of 2020. And that's really one of the big home runs we've had. So thank you, everybody, and drive carefully.